Good evening, students. Welcome to this session. I hope you have revised the session, what we have done in the last class. So I'll just quickly recap what we have done is. So we were discussing about the depreciation. Yes, good evening, Manshika. We were discussing in the last class about depreciation. So we were on the depreciation, which is in the two format that we have. One is for the power generating units, which is the depreciation on the SLM basis, and the second one that we had it was the depreciation on the WDV basis, right? Which is for the normal units. So for the power generating units, if you remember, it was an optional scheme which they could exercise, and basically then they can go as per the SLM basis if they exercise the option before the due date of filing return of income. Then we saw that they had something called as terminal depreciation if there is any deficiency on the sale, transfer, or disposal of the asset. So then the deficiency can be allowed as a deduction, which is called as terminal depreciation. And there was something called as the balancing charge. So under 32(3), this particular thing, terminal depreciation is allowed, and under 41, the balancing charge is there, which is the excess amount. So the excess amount which will be there over and above what has been allowed to you in the past will be taken as the what is allowed to you in the past is going to be taken as 41(2) balancing charge. Over and above that will be capital gain under section 58. So that is what is for the power generating units, right? And then we saw for the WDV basis, we have the condition of that the asset should be used for the purpose of business. The asset should be owned by the assessee. Ownership meaning what? That I should have the right to use in terms of the asset that I have. Legal ownership may not be necessary, but what I should be having is that I have the ownership of that asset to the exclusion of others. So if you remember, in the case of hire purchase, the hire purchaser will get the depreciation benefit if the property is eventually going to pass to him. In case of lease, it is the lessor who will get the depreciation. There's an explanation 1A, which is the exception to that the lessee can also get the deduction of the depreciation on the leased asset if he has incurred the expenses on the repair renovation of that building and has done substantial construction on that, right? So basically, that is what is the exception to that. Then we went on to the depreciation as I said that it is as per the block of asset concept, which is given under 43(6)(c). It is defined what is WDV. Now, WDV for the assets which are purchased during the year is the actual cost. Now, what is actual cost? The actual cost is the actual cost incurred by the assessee. So, if you remember, we had referred to the Supreme Court judgment in Chellapalli Sugar Mills, which said that it is the actual cost, which you understand in the common parlance. So, it will include all the expenses which are incurred to bring the asset to the existence or in the workability of that particular asset. All the costs which are there has to be included. So basically freight, transport charges, then the trial expenses, installation costs, all of that will get capitalized. So that is the actual cost definition as reduced by the cost which is reimbursed by some other authority. So the subsidies, waiver of the bank loan will get excluded. Then we went on to the ICDS. Which ICDS? If we go into ICDS 7, which is government grants. So in case of the depreciable asset, you will have to reduce the government grants from the cost of the asset. And if it is for any other than the depreciable asset, then it will be considered as income under section 224, right? And you have to recognize as per ICDS. So for the non-depreciable asset, how will you recognize? So the recognition which are there has to be recognized on the basis that the income over the cost of meeting the obligation over that period, it will be recognized. In case it is in terms of the financial support, then you have to recognize in the year in which it is received. However, the recognition will not be postponed beyond the receipt. The grants have to be otherwise recognized only when there's a reasonable certainty that it will be received and the conditions will be complied with. And finally, in case of non-monetary asset which is received at a concessional price as a grant, you have to record it at the acquisition cost, right? And then we went on to the section 43(1) to understand the meaning of the actual cost. So now we are going to, we also looked at the ICDS file. which says that actual cost shall comprise of the purchase price plus any taxes and any other cost to make the asset ready for use. Is it clear? Yes. Okay. Good evening, Viraj. Good evening, Shankara. Now we move further. Okay. So let's start with it. Now we were discussing about the meaning of the actual cost. And as I said, it is defined under 43.1. Now, if you look at the meaning of the actual cost, it says that what else we need to exclude it. What else we need to exclude it is the, let's say for example, if the purchase has been done in cash, if the assets are purchased in cash greater than rupees 10,000, then in that case, that amount will not be considered in the actual cost. So in case you have purchased the asset in cash, then you need to exclude it from the cost of the asset. So just write down, exclude the asset purchased in cash. Cash purchases greater than rupees 10,000 or repayment of loan which is greater than rupees 10,000 has to be excluded. Just write it over here. You have to reduce the cash expense greater than rupees, not cash expense, you can write down the asset purchased in cash. Greater than rupees 10,000, you will not consider in the cost because the way that the expenses are not allowed to you when you incur in cash over rupees 10,000. Similar way, the capital asset will also not be eligible for depreciation. So you cannot really claim any depreciation on such asset and you will not be considering it in the cost of acquisition. Or any, if for example, any repayment is also made, which is more than rupees 10,000. So repayment in terms of the loan which you have taken, right? So where the assessee incurs any expenditure for acquisition of asset or towards the payment in terms of towards that asset in a day to any person otherwise than by account pay check, account pay bank drop or ECS or any other electronic mode exceeding rupees 10,000, such expenditure will be ignored. Okay. Next particular explanation which is important over here is that where the asset is used in the business after it ceases to be used for the scientific research. So let's say for example, I have taken the asset for the scientific research. Now any expenditure that you incur for the scientific research will be allowed to you as the deduction under 35(1)(4). If you remember, the capital asset also, the capital expenditure also is allowed to you under the 35. So 35(1)(4) will allow to you the deduction. Now you would have already taken it as a deduction. Now you would have used the asset for the scientific research and now you may be transferring it over here. In that case, the actual cost of the assessee for that asset will be nil. The actual cost will be nil because that expenditure, that particular asset is already allowed to you as a deduction. So now the actual cost will be nil. Second one. So you can write it this also point over here. Asset purchased for which deduction claimed 35(1)(4) actual cost will be nil. Actual cost is going to be nil. The second explanation which is there is the asset which is, let's say for example, converted through the stock in trade. The asset, if it is converted through the stock in trade, what will be the actual cost? Yes, students. What shall be the actual cost of asset when it is converted from the stock in trade? We have already done this. Yes. Yes, students. What will be the actual cost? So if the stock in trade is converted into the capital asset, what will be the actual cost of that capital asset? We have done that 2 days back only. Yes. What will be the actual cost? Yes. Nobody remembers? You're not revising. So 28.4, conversion of stock in trade into a capital asset. Yes. The actual cost of that asset will be the fair market value. So the actual cost will be the fair market value, which is charged to tax under 21(6)(a). Not 21(4), sorry, 21(6)(a). So if you remember, we have already done this. This is where I had given you the reference. This is explanation 1A to section 43. Yes, Prerna, it is SDV for immovable property. For others, it is the open market value. Yes, Vanshika, FMV is correct. Yes, Vinay, correct. So, in case of the capital asset, which is, sorry, stock in trade converted to capital asset, it will be the FMV. Clear? Okay. Now, this I'm not writing because any which ways we have already considered this particular point in 28(6)(a). Now, let's try and understand one very, very important aspect. The interest which is paid on the loan which is acquired or loan which is borrowed for the purpose of acquiring the asset. So, if I have paid the interest on the loan borrowed for the purpose of acquiring the asset, explanation 8 says that the interest shall be capitalized till the time the asset is put to use. Till the time the asset is put to use. The interest after when the asset is put to use will not be capitalized. I'm taking here this one below. So you can write down capitalize interest on loan borrowed till the time asset is first put to use. This is explanation 8 to section 43.1. Now, if you look at the section 36, which is for the interest, section 36(1)(3) for the interest also provides for the similar provision. It says that the interest on capital borrowed for the acquisition of asset will not be allowed as deduction for the period from borrowing till the time asset is put to use. So 36(1)(3) says the similar thing. You can write it over here. So section 36(1)(3), which allows you the deduction of interest. So interest on loan borrowed in connection with acquisition of asset will not be allowed as the deduction from period of borrowing till asset first put to use. So basically the interest also needs to be capitalized. Now in this connection, I'm again referring to the ICDS 9, which is the borrowing cost. So ICDS 9, write down over here. ICDS 9, borrowing cost. ICDS 9, the borrowing cost. Now what does ICDS 9 provides for in terms of the borrowing cost? ICDS 9 says that what is first of all the borrowing cost? It defines borrowing cost as interest, any commitment charges, any discount or premium, or any ancillary cost which are incurred in connection with the arrangement of borrowings, or any finance charges in respect of lease, finance lease. All of that is my borrowing cost. So what is my borrowing cost? My borrowing cost is, just write down, the interest plus the commitment charges plus discount or premium relating to borrowing, any ancillary cost for arrangement of borrowing, finance charges for finance lease. All of this comes under the borrowing cost. Now, what does it say? It says that you have to divide it in two aspects. The borrowing costs are divided into two aspects. One is the cost which is attributable to the purchase, construction, production or manufacturing of the qualifying asset. And secondly, where the borrowing cost is not directly attributable to the qualifying asset, means it's a general loan. So we have to divide it into two segments. So ICDS 9 borrowing cost, I'm first dividing it into, the first segment is the borrowing cost that is directly attributable to the acquisition, construction or manufacturing of qualifying asset. Now what is my qualifying asset? A qualifying asset means the land, building, plant and machinery, right? Furniture or the intangibles Of course, other than the goodwill. So know-how, patents, all of that. Now the borrowing costs that are attributable directly to the acquisition, construction or the production of qualifying asset shall be capitalized as the part of the cost of that asset. So what your explanation 8, what your 36 monthly says, the same thing ICDS 9 also says. Capitalize this cost. Now, what will be the period of capitalization? The date on which funds were borrowed, from that date till the date of the asset when it is put to use. So capitalize from date when funds are borrowed till date when asset first put to use. So it's the same thing what the 3613 and the explanation 8 is saying. As far as the borrowing cost, which is not directly attributable. So the borrowing costs which are not directly attributable to the qualifying asset. It could be general loans and advances. So you can write it. Sorry. Borrowing cost not directly attributable, that is general loans. How will you capitalize? It will be capitalized in the form of A into B divided by C. What is A? A is the borrowing cost, which is my interest. B is the cost of the qualifying asset, average cost of the qualifying asset. And C is the average of the total assets. Right? Now, this will be capitalized again from the period, from the date on which funds were utilized, and again till the time that the assets are first put to use. Fine. So date from when the asset, from the when funds are utilized till the date on which the asset is first put to use. So write down. From, no, sorry, you can write over here like this. Second. Give me a minute. You can write down capitalize from date when funds are utilized till date when asset first put to use. Okay. Now, next important aspect is the gain or loss on the foreign exchange. Gain or loss on the foreign exchange. Now, what will happen in that particular case? So, let's say, for example, I have I have purchased the asset from outside India through a loan, which is also taken from outside India. Now, there will be the exchange gain and loss. How will we recognize that particular gain or loss? Now, for that, we have to refer to section 43A. Now, this is a specific provision. So, the gain or loss on foreign exchange fluctuation. This is a specific provision under section 43A. Now, what does section 43A provides? Be very, very careful and attentive. Mansha, I didn't get your doubt. Substantial renovation in terms of what? Are you talking about the when lessee is entitled to depreciation, that particular point? So section 43A, which is there, is a specific provision. It is a non-obstant clause, a notwithstanding clause. It says where the assessee has acquired the asset. So this first condition is asset acquired outside India. Has acquired the asset from a country outside India. And there could be the change in the rate of exchange towards the payment of the cost of asset, or has taken loan or has taken the loan in foreign exchange to acquire that particular asset. To acquire asset outside India. Then in that case, section 43A says that the foreign exchange gain or loss, irrespective of the method of accounting adopted by the assessee, shall be added to or deducted from the actual cost of asset. Shall be added to or deducted from the actual cost of asset. So you can write it over here, add or less from actual cost. But when do we have to do that? When the amount is paid at the time of making the payment. So not at the time of incurring the liability. This is on the payment basis. So this is irrespective of the method of accounting followed by the assessee. Section 43A provides that the gain or loss shall be added or deducted from the actual cost at the time of making the payments. Now this is only applicable, be mindful, when the asset is acquired outside India and it is financed through the loan which is borrowed from outside India. If the loan is in INR, then this will not be applicable, even if the asset is from outside India. Or if the asset is in India, again, this will not be applicable. Are we clear? So this is only applicable when these conditions are fulfilled. Now again, I am referring back to the Mansha, purpose of borrowing can be even substantial renovation of the asset also, because it will increase the life of the asset. The performance of the asset will be increased. So then you will obviously capitalize that cost. And if the loan is borrowed in connection with that, of course, you will even capitalize the interest portion. Clear, Mansha? Okay. Now I'm referring to the ICDS 6, which is foreign exchange gain or loss. See, we have almost done all the ICDS in connection with the each and every provision. So we have done, let's say, ICDS 1 in the first class, 2 in the first class, 4 in the first class we have done. Then we did tangible fixed assets. We did government grants 7. Securities we have done in the first class. Now we are doing 9. 10 also we have done as a part of the first class. The only one which is remaining now is the ICDS 3, which is construction contract. That we are going to separately deal. Other than that, see, I've completed all the ICDS at the respective places, and that's how it has to be done. You don't need to do it in isolation, but with the each provision. Now, if you look at ICDS 6, what does it say? ICDS 6 talks about the gain or loss. Now, again, it has been divided into several segments. For the monetary item, how do you recognize? So, the foreign exchange gain and loss for the monetary item. What is the meaning of monetary item? Yes, students. What is monetary item and what is non-monetary item? Yes. What is a monetary item? Yes. What is monetary item, students? No, there should not be and between point 1 and 2, Rahul, because 43A says that in case you acquire the asset outside India with your own money or through the borrowing which is taken in foreign currency. It could be through own money also. So when you make the payment of the cost of that asset, even then 43A will be applicable. Are we clear? So it is or and not and. Kita, yes, it is related to money. Monetary means which involves money. No, it's not the correct definition. Which can be defined in currency. See, monetary item, it is, you have done all as a part of, right, SFM accounts. So monetary item means which are in the fixed or determinable amounts of money. Example, receivables, payables, cash. These are the examples of the monetary item. Non-monetary, which is other than the monetary, like fixed assets, inventories, investments, equity, all of that is the non-monetary item. So this is determinable in fixed, determinable in fixed form of the money or fixed amount of money. Example, cash, receivables, or payables. Here it means fixed assets, inventory, investment. Okay. Now for the monetary item, ICDS 6 says that you have to recognize as on the first the initial recognition has to be done. A foreign currency transaction shall be recorded initially by applying the foreign currency amount with the exchange rate as on the date of the transaction. So the initial recognition is same for every asset. Initial recognition at the rate on date of transaction. So first you have to always do the initial recognition. How will you initially recognize? Which will be based on the rate on the date of the transaction. Now, as on the last day of the previous year, as on the last day of the previous year, on the closing date, what do we need to do? So if it is a monetary amount, it's a monetary item, they shall be converted into they shall be converted by applying the exchange rate as on the closing date. So they have to be converted based on the closing rate. And accordingly, what you will do is you will recognize the gain or loss on the mark-to-market basis. You will recognize the gain or loss on mark-to-market basis. So on the closing date, convert or on the closing date, value as on the closing date as per the exchange rate on that date. So basically recognize the mark to market losses. So on each closing date, you will value these assets, the monetary assets. For the non-monetary item, now they are to be valued by using the exchange rate as on the date of transaction. So any exchange difference arising on the last day shall not be recognized as income or expense. So for the monetary item, you will recognize M2M losses or the gains. For the monetary item, you will recognize the M2M losses or gain, and this shall be recognized as income or the expense for that year. This has to be valued on the date of, as per the exchange rate on date of transaction. So gain or loss not to be recognized. Gain or loss is not to be recognized. The only exception to this is, so the exception to this is 43A. When you do the payment, you will recognize it. Fine. So the exception to this is going to be the 43A. Are we clear? Then they talk about the forward exchange contracts. Then they talk about, under the ICDS 6, about the forward exchange contracts. What about the forward exchange contract? So the forward exchange contracts which are there, these are basically agreement to exchange the different currencies at a forward rate, right? You would have done in SFM. So any option or future contracts which are there. Now any premium or discount on the forward exchange contract shall be amortized over the life of the contract. So any premium or discount amortize over life of the contract. Any premium or discount has to be recognized as the or has to be amortized over the life of the contract. Are we clear? In case of hedging, contract, so in that particular case, how will you recognize? That has to be recognized at the time of settlement. Recognized at the time of settlement. So any premium, discount, exchange differences are to be recognized on the settlement itself. For the forward contract, any exchange differences which are arising, that you have to recognize on M2M basis. So here you can write down exchange difference on M2M to be recognized. Fine. Last one point over here. In terms of the foreign operations, in terms of if there are any foreign operations, So the financial statement of the foreign operation will be recognized as per these principle only. That meaning you will initially recognize as per the date on the date of the transaction, and then the monetary items and non-monetary items will be converted. The monetary will be converted, non-monetary will not be converted as on the closing date. Are we clear? Yes or no? Any questions so far? Yes? Okay. So now this is the meaning of the actual cost, what we have done over here. So now where were we in the last class? I had told you that WDV for the newly acquired asset is the actual cost under 43.1. Now there are certain other actual costs which we need to take into consideration. And what are those? So there are certain actual costs where the value is given on the basis of the Income Tax Act itself. So we will do first that and then we will move to WDV. So as I told you, actual cost in respect of transfer of the asset from scientific research use to the business use, it will be nil. For the asset which is acquired by way of the gift or inheritance, the asset which is acquired by way of gift or inheritance, in that case, how will you do actual cost? You can write over here. I'm taking it down, this one. So you can write it over here, actual cost, other cases. So asset which is purchased for which deduction claimed under 3514, we have taken nil. Secondly, asset converted from stock in trade, FMV, on the date of conversion, taxed under section 28(6)(a). Then asset acquired through gift or inheritance, cost to the previous owner. Cost to the previous owner, isn't it? So what you do under the capital gain also, similar thing we have to consider over here. Then in terms of the actual cost, where before the date of acquisition, the asset was used. The asset was used by any other person. And if the AO believes that the main purpose of transferring the asset to the assessee was to reduce the income tax liability by claiming the depreciation on enhanced cost. So let's say, for example, if the A is purchasing the asset from B, and the purpose of this is, to claim depreciation on enhanced cost. So deliberately this has been transferred at a higher amount. So in that particular case, asset purchased which is used by any other person and AO is satisfied that main purpose is to reduce tax, then in that particular case, the AO can determine the amount. AO may determine. The actual cost will be determined by the AO. Next one is where the asset once belonged to me and I was using it for the business or profession. And now I have given it to somebody else. I have transferred that asset. And now again I am reacquiring it. And again I am reacquiring it. So then in that particular case, so A had transferred the asset to B, right? I was using this, let's say plant and machinery for my business or profession. And now again I am reacquiring. Again I am reacquiring. Then in that particular case, the actual cost which will be there is the actual cost lower of, the actual cost will be lower of actual cost minus the depreciation actual cost at which I had first acquired, the price paid to reacquire. The price paid to reacquire. Lower of that will be allowed. Are we clear? So this one is different from this. Here, if the AO finds out that the main purpose of doing this was to claim the depreciation on enhanced cost. But here, if I am transferring and reacquiring, then this will be there. Here, intention will not matter. In this particular earlier case, the intention is that if I am doing it for the purpose of avoiding the or for purpose of reducing the tax. Next case is where before the date of acquisition, I was using the asset. Right? Now, the assets were now being used by, let's say, some another person. So, let's say Mr. A is using the asset for the business. Right? Now, let's say, for example, he is also claiming the depreciation. And now he has, let's say, transferred the asset to Mr. B. And now he's taking it back on lease or hire. So I was using the asset, I've transferred it, and now I am taking the asset on lease. Now in this case, the actual cost for B, the actual cost for B is actual cost for A is not B, sorry. So let's say, for example, if A is using the assets at any time and now it has been transferred to Mr. B, right? And now it has been leased back to A. So this is a case of sale and lease back. This is a case of sale and lease back. Now B has acquired this asset and A is acquiring on the lease or hire. Sorry, actual cost for B only, not A, because B has acquired. The actual cost of the transferred asset in the case of B shall be the written down value for A, the WDV for A. Fine. Next particular case is when, let's say, for example, the building was used for the personal purpose and now it has been introduced in business. Building which was used for personal use and now used for or now introduced for business or profession. So what will be my actual cost? The actual cost minus the depreciation as it would have been allowed to me since the date of acquisition. So actual cost minus notional depreciation since date of acquisition. Fine. Next scenario is, let's say for example, when the asset is transferred by the holding company to the subsidiary company or by a subsidiary company to the 100% holding company. So it will be the cost which would have been in the hands of the transferor. Similar case is in the case of amalgamation. If in the scheme of amalgamation, capital asset is transferred by amalgamating company to the amalgamated company. So actual cost of the amalgamated company will be that becoming of the amalgamating company. Same is in the case of the demerger. So for the resulting company, it shall be the actual cost to the whole to the merged company, but it will not exceed the WDV if it would have been in the hands of the demerged company. Fine. So you can write down for transfer to wholly owned subsidiary or the holding company or amalgamation or the demerger, actual cost to the previous owner. Right? So actual cost which was there to the previous owner. Or basically it was going to be the WDV. M2M Prerna means mark to market. Shravanand, of course, they would be knowing based on the information that they could get it from each other. Okay. So WDV of A will get B or B will inform to the A about the WDV. Fine. Yes or no? Any questions about the actual cost? Now, as I told you, we will move towards the again section 43.6, which is the meaning of WDV. So for newly acquired asset, it is the actual cost. Actual cost is defined under 43.1, and 43.1 has several explanations for different actual cost. Here in the less, you can also write any SENVAT credit. So if any credit is claimed for the GST, you can reduce it over here from the cost. Okay. Now for the previously acquired asset. For the previously acquired asset, if you remember, I have divided again into three parts. WDV on notional basis, WDV of the previous owner, WDV will be equal to the nil. So, first is WDV on the notional basis. First, we'll discuss about that. Now, when the WDV will be taken to be on the notional basis, let's write those scenarios. So, in case of the succession, or sorry, not succession, in case of, let's say for example, earlier I was going for the composite income. I had the composite income. Composite income means the agricultural income, business income is my, basically I have the agricultural income. And plus I have, let's say, business income also. So now what will happen? In the case of composite income, we have a separate provision. We have a separate provision, isn't it? Which provides that your 40% of the amount is considered to be the exempt amount. Right? So, in case of where I have a composite income, in case where I have a composite income, so then I would have, let's say, the agriculture income plus the business income. And then Rule 8 says that 40% of such income will be considered to be liable to income tax, 60% will be exempt. Right? Now, in that case, how will you compute the depreciation? So you can write out over here. composite income. Composite income. So if let's say for example, I have let's say turnover of 20 lakhs and I have let's say expenses of 4 lakh and I have depreciation of 1 lakh. Then my income is 20 lakh minus depreciation of 1 lakh minus expenses of 4 lakh, 5 lakh. So 15 lakh will be my income. Now what will be considered as taxable income? Only 40%. But what will happen to the depreciation? So how will I compute my WDV? Will I take 40% of 1 lakh for the purpose of calculating WDV? The answer is no. So the entire depreciation full depreciation would be reduced from cost. So let's say I have income of rupees 16 lakh minus depreciation is let's say rupees 1 lakh. So my income will become 15 lakh. 40% of 15 lakh is taxable as PGBP, right? So in that particular case, for the purpose of rupees 1 lakh will be reduced. So in case of composite income, entire WDV will be considered. Fine. Next, where is the notional basis? Where is the WDV calculated on the notional basis? So just now you saw that if the assets which are used for the personal purpose and now being introduced into business. So the same example, I'll write it over here so that you have the easy remembrance. Building which is used for the personal purpose and now introduced for the business or profession. So if you look at it, the actual cost minus notional depreciation since the date of acquisition I am taking. So you can put this particular point above as well. Let me just copy. Because this will also come for the purpose of WDV on the notional basis. Okay. So this is the second example. Right. So here also, if you see that we have calculated the WDV on the notional basis. Clear? Okay. Next particular case, where do we do it on the notional basis? Where do we do it on the notional basis? Yes. Just now we saw the example. How do you calculate the WDV on the notional basis? So in case, let's say for example, where I have now the case of the sale and lease back. In that also we are calculating it on the notional basis only. If you look at it, we are calculating on the notional basis. Are we clear? Third case is where let's say for example, I was exempt from the income tax. Now I have become taxable. And my business income has become taxable. In that particular case, again, the asset which was there will remain now in the business and the depreciation will considered to be notionally allowed. Even though the person is considered to be exempt from the tax. Are we clear? So you can write it over here. Sorry, you can write it over here. Here, sale and lease back, also point you can write it, which we have written down. Or if you want, you can just, put it here because that was on the notional basis. These 2 points, if you want, you can put it above. Fine. Now we'll go back to the WDV when it is WDV of the previous owner. Now this will happen in the case of WDV of the previous owner. This is in the case of the demerger, amalgamation, succession of the business. Right? So in case of the succession of the business, when in the case of succession of the business or profession, the written down value will be taken to be the written down value of the predecessor, right? Or transfer of asset by holding company to wholly owned subsidiary and vice versa. So for the manner in which, you deem the actual cost also to the cost to the previous owner, even for the WDV, it will remain the same. So where the block of asset is transferred by holding company to wholly owned subsidiary or the subsidiary to the wholly owned company, then, sorry, to the 100% holding company, then the actual cost of the block of assets shall be the written down value in the hands of the transferor company. Same thing will happen in the case of the amalgamation as well. So the way you deem the actual cost of the assets which are acquired during the previous year as the cost to the previous owner. So this is WDV I am talking about. There I was talking about the actual cost. Now actual cost means what? That the cost for the assets which are acquired during previous year. If during the previous year any asset is getting transferred, it will be the cost to the previous owner. But if the block of assets is transferred, it will be the WDV. In the case of demerger, for the resulting company, again, it will be the same thing. So it will be the WDV of the demerged company minus the written down value, which is getting transferred to the resulting company. For the demerged company, it will be the WDV, which is of the assets which are remaining after getting transferred to the resulting company. For the resulting company, it will be the WDV of the company which has been demerged. Similar thing is in the case of conversion of company to LLP. Conversion of company to the LLP. Are we getting? Yes. Now, when will the WDV will be considered as nil? When will the WDV be considered as nil? So, WDV will be considered as nil in 2 scenarios. When the assets, all the assets in the block are transferred. When all the assets in the block are getting transferred. Secondly, when the money receivable on the sale of assets, on the asset sale, is greater than the WDV plus the actual cost. Then in this particular case, we will have the capital gain. We will have the capital gain which will be deemed to be the short-term capital gain under section 50. So this will be my short-term capital gain under section 50. So where the consideration received for the block of asset is greater than the written down value and the actual cost, that will be deemed to be the capital gain arising from the transfer of short-term capital assets. Will be deemed to be the short-term capital gain. Are we clear? Or when the block of assets cease to exist, when all the assets are getting transferred, right? Then also it will be considered as the short-term capital loss. Okay. So this is block cease to exist. Are we clear about this? Yes, any questions? Any doubt, any question? Geeta, what are you asking about rent? I did not get that question. Yes. Okay. Now, next is about the additional depreciation. Next is the additional depreciation. Write down. So we have seen what is the actual cost. Next is the depreciation which is there. Additional depreciation. So now for the additional depreciation, when is the additional depreciation being allowed? Yes. When is the additional depreciation allowed to me? Yes, students. So additional depreciation under section 32(1)(2)(a). Yes. So I'm putting out the additional depreciation over here. Now, when is the additional depreciation allowed to me? Yes, students. And what are the conditions for that? Yes. So, for the additional depreciation, this is at the rate of the 20%. The additional depreciation is there, which is at the rate of the 20%. So, I'm first giving you the section which is there, which is section 32. I want you to read this section before we dwell upon this, because again, this is very, very, very important. So just read this 32(1)(2)(a). I'm sharing the screen, the main provision of the section. Yes. So 32(1)(2)(a), if you look at it, it says in case of new machinery or plant, which has been acquired and installed by an assessee engaged in the business of manufacture or production of an article or thing, or in the business of generation, transmission, or the distribution of power. So, we will write now onto the screen and make a table. So, 32(1)(2)(a) is 20% of the actual cost. Additional depreciation under section 32(1)(2)(a) is 20% of the actual cost. What are the conditions? The first condition is that it has to be acquired by the undertaking which is into the business of, who is the eligible assessee? In the business of manufacturing or production, plus generation or distribution of electricity or transmission of the power. So the eligible assessee is one who is engaged in manufacturing, right? Or the manufacturing or the production of any article. Or thing, right? Or generation or the distribution or transmission of power. Generation, distribution or transmission of the power. Now, one important aspect over here which is worthwhile to note. Please be very careful. For the manufacturing, they say that even the printing, whether that will be considered as manufacturing. So it says that an assessee which is engaged in printing and publishing will be considered to be in the manufacturing. The CBDT has clarified that. So you can write down here. So, in the question in the examination, it may be mentioned in the first sentence of your question. The assessee is engaged in printing and publishing of books. So you should be careful that you will claim the additional depreciation. Do not miss any point in the exam. That could have an implication. They may not write that is engaged in manufacturing. They may just write is engaged in printing and publishing of books. So printing and publishing is considered as manufacturing. This is clarified by the CBDT. So you can write down. This is clarified by the CBDT. Just write over here. Sorry. CBDT circular. Fine. Now, what are the eligible assets? What are the eligible assets which are there? So, plant and machinery. But there are certain disqualifications to the plant and machinery which are there. So, which plant and machinery are allowed over here? Let's write down. So, eligible asset is my plant and machinery. Now, what is not considered over here is, what are the ineligible assets? You can write down. What are the ineligible assets? The plant and machinery which was used by somebody else, which is second-hand plant and machinery. Second-hand plant and machinery. Second, plant and machinery installed in office premises. Installed in office premises or the residential accommodation. Third is office appliances. Fourth is if the road transport vehicles are there. Okay. So these are my ineligible plant and machinery. Ineligible assets. Now what you will get is 20% as the depreciation. In case the assets are used for less than 180 days, then you will get 10%. Fine? You will get 10%. Now for the rates of depreciation which are given for the other assets. Okay, one more important point over here before we move ahead. In case you get 10% as the depreciation if you use for less than 180 days, then the balance 10% will be allowed to you in the succeeding year. The balance 10% will be allowed to you in the succeeding year. Are we clear about that? So the balance 10% you can write down will be allowed in the next year. Balance 10% in next assessment year. Fine. So 10% you will get it now, 10% you will get it in the next year. Also, one important note over here, additional depreciation not allowed if optional tax regime exercised under section 115 BAA, 115 BAB. 115 BAA, 115 BAB, or for the cooperative society which is there 115 BAD or BAE. Ma'am, what about the individuals in HUF? It is not optional. It is a default regime. If default regime for individual or HUF under section 115 BAs. If you're going for the default regime, you will not get additional depreciation. Fine? Yes. Then, what are the rates of the depreciation? The rates of the depreciation are given under Rule 5.1. Are given under Rule 5.1. The rates of the depreciation are given. For the power generating unit, it is given under Rule 5.1a. For the normal WDV concept, it is given under Rule 5.1, under the income tax rule. Now, what are the rates of the depreciation which are given? So for that, we will have a look into the rates of depreciation before we move on further. Let me open the rates of the depreciation for you. So you will have to go to the appendix to find the rate of depreciation. So Rule 5.1 talks about the rates of depreciation, but the rate of depreciation which is actually given is given under the appendix 1. So, okay, so I'll just show you. So for the buildings, if you look at it, it is 10%. Then the highest rate is restricted to 40%. Furniture and fittings, it is 10%. Machinery and plant, it is 15%. Motor cars, it is 15%. For the computers which are there, it is 40%. And then there are several other rates of depreciation, but with the highest depreciation is 40%. It is given under the appendix 1 to the income tax rules. Fine. Now, a few important things which I would like to discuss over here in terms of the rates of the depreciation. What about the EPPX system? What about the EPPX system? Yes. EPPX, you know, or the mobile phones basically, whether 40% will be allowed or whether it will be considered under the furnitures or 15% machinery will be allowed. So what will be the rate of depreciation for the mobile phones? Yes. What will be the rate of depreciation past? Yes, students, faster. 15%. Yes, Geeta, you are correct. Shafna, yes, correct. So it is a 15% rate which is allowed on the EPPX and mobile phone. So you can write down EPPX and mobile phones are not computers. Therefore, depreciation at the rate of 15% and not 40%. Fine. Okay, students. So for the EPPX and mobile phone, the depreciation will be at the rate of 15% and not 40%. Last one important thing in the depreciation, which is the concept of proportional depreciation. Now, what is this proportional depreciation? So see, in the case of amalgamation, in the case of the demerger, or basically in the case of the conversion of the sole proprietary into company to LLP, the total depreciation which will be allowed to the predecessor and the successor will be apportioned based on the number of days assets were used by them. So just write down for the amalgamation, demerger, conversion of sole proprietary into company, conversion of company to the LLP. In all these cases, the proportional depreciation will be allowed to you. So, what is the proportional depreciation? That the depreciation will be apportioned between the two based on the number of days for which the asset has been used. Okay, based on which the number of days the asset has been used. So, depreciation to be proportionally apportioned between predecessor and the successor based on number of days asset is used. Okay, in the ratio of number of days in which the asset is used. So first the depreciation will be calculated as if the business has not been reorganized, and then the depreciation will be apportioned between the two. Fine. So I'll show you one example from the module itself. Let's have a look at it just for your understanding. See, there is this Sign Limited has a block of assets carrying 15% rate of depreciation, whose WDV after reducing the depreciation was 40 lakh. It has purchased another second-hand plant and machinery of 111 for 14.4 lakh and put to use on same day. Now it was amalgamated with Shirdi Limited with effect from 1st January. So you are required to compute the depreciation assuming assets were transferred to Shirdi at rupees 60 lakh. Now if you look at it, the opening WDV is 40 lakh, right? After the depreciation, there is addition of the assets which is amounting to 14.40 lakh. So that we have taken. So total assets is 54.40 lakh. On these assets, 40 lakh, 15% depreciation is there. It's plant and machinery. It's a second-hand plant and machinery. So there is no additional depreciation on this also. So on 14.4 lakh, since this is acquired when? This is acquired on 111. So less than 180 days. So 7.5%. Now this is the total depreciation, 7 lakh 8,000. Now this will be a portion between the amalgamating and the amalgamated company. Both of them. For 6 lakh rupees which is there, which is this particular depreciation. This will be apportioned based on the date which is 1st April to 1st January, when the assets are transferred, right? And this will be apportioned 1,08,000 on the new asset from 1/11 to 1st January. And balance will go to the amalgamated company. Now, what will be the cost for the amalgamated company? For the amalgamated company, the cost will be this 14,40,000 only. The price at which it has been transferred will not have any implication. The 60 lakh will not matter. And the WDV of the other assets will be 40 lakh minus 6 lakh. That will be the cost to the amalgamated company. Are we clear? Yes or no? Right? So this is how you have to basically do. Last one thing with respect to the unabsorbed depreciation. So any balance depreciation which you are not able to set off, you have to carry forward as unabsorbed depreciation. Now this will be carried forward for indefinite period and can be set off against any other head except salary. So that will be considered as the depreciation of the current year. Fine. So you can write down here unabsorbed depreciation deemed to be current year depreciation set off against any head of income other than salaries. Deemed to be the current year depreciation. Okay. So this is time limit, which is indefinite. Okay. This is under section 32. Fine. Now, what is the order of set off? So this is going to be for indefinite period. So how will you set off? Basically, you will set off on the basis of the first current year depreciation, then brought forward business loss, and then the unabsorbed depreciation you will set off. So first you will see current year depreciation because that is your current year depreciation. Then brought forward business loss because this has a time limit. And then the unabsorbed depreciation if the profits are left. Okay. So let's say, for example, if I have 10 lakh rupees as profit, first I will, let's say, set off the depreciation of current year, let's say 1 lakh. Let's say I have brought forward business loss of, let's say, maybe 8 lakhs. So, and let's say I have unabsorbed depreciation of 3 lakh. So what I'll do is, I will set off only 1 lakh against this balance 2 lakh I will carry forward. Fine. Yes, students, any doubt, any question? We are done with the depreciation. Okay. So let's take a small break of 10 minutes and then we get back. Okay. Now let's move forward. Now we will not do 33 to 35 AD, all of those. I'll directly jump on to section 36. Why I'll tell you is because those are specific deduction. First, we'll finish off the smaller deduction. So you can write this as a new chapter under PGBP, allowances and disallowances. Fine. So the first one was under PGBP. This is also under PGBP only, but we are doing the allowances and disallowances under PGBP. So I'm giving it a new heading, right? Okay. So section 36 is what we are going to start with. Now I will divide it into three segments. Employment related deductions, finance related deductions, and others. Fine. So this we are going to quickly wrap it up, section 36, because these are generally the deductions which are important, right? So let's get quickly started with it. Now under the deduction section 36, first we are going to deal with the employment related deduction under section 36. Now the first employment related deduction is in terms of the amount which is paid. Amount which is paid by the employer in respect of the contribution towards the recognized provident fund. Right? So that is allowed as deduction. So the amount which is paid by the employer in respect of the contribution to the recognized provident fund, that is allowed as deduction under section 36. So you can write down, or first let's before that, first let's deal with 36.1.1b. One second. Let us first deal with 36.1.1b because that will come later. So let's do it. Otherwise, you will not be able to remember the section numbers correctly. So let's first deal with that. So first is the amount of insurance premium. Insurance premium paid by the employer. Insurance premium paid by the employer other than in cash. Other than in cash for the health office employees. So you can write here, instead of insurance premium, maybe you can write health insurance premium. This is allowed as deduction under 36.1.1b. This is allowed as deduction under section 36.1.1b. Second is the amount paid to the employee as bonus or commission. Bonus or commission paid to the employee for services rendered other than the profits or dividend. Okay, so any sum paid to an employee as bonus or commission for services rendered other than profits or dividend. So if it is in the nature of profits or dividend, so let's say for example, I would have given, let's say the profit distribution or the dividend to them. Instead of that, I'm camouflaging as bonus or commission because profit or dividend will not be allowed as deduction, right? But the bonus or commission will be. So what company may try to do is instead of profit or instead of distributing dividend, I will give the bonus or commission. Then if it is of that nature, if it is in the nature of profit or dividend, then it will not be allowed as deduction. So only other than the profit or dividend, the bonus or commission will be allowed as deduction to me. Now be very careful over here. This particular sum, which is bonus or commission, is subject to the provisions of section 43B. This will be subject to the provisions of section 43B. What is 43B? 43B is deduction on the payment basis. Deduction on the payment basis, right? So in case of the bonus or commission which is paid to the employees, that will be given as, or that will be allowed as the deduction only when you make the payment before the due date of filing the return of income. Otherwise, you will not get that deduction. Are we getting that? So that will be given to you as deduction only when you make the payment before the due date of filing the return of income. So just write down, this will be subject to section 43B. Subject to 43B. This will also be subject to section 40A2. What is 40A2? Payment to the related parties. Payment to the related parties. If my bonus or commission is being paid to a related party, to a related director, right? Then in that particular case, this will also be subject to 40A2. So this particular provision of 3612 is essentially in order to prevent the companies from claiming the bonus or commission as an expenditure instead of distributing the profits, right? Or by camouflaging the profits or dividends as the bonus. So this is fully deductible provided the sum paid as bonus or commission is not in the nature of profits or dividends. Next particular deduction which is there is for the employees. This is 3614, which is, so this was 36.1, this was section 36.1.2. That's why I said we will do line by line so that you remember the numbers at least. Section 36.1.2. Health insurance 1B and this bonus or commission is 2. Then employer contribution to the recognized provident fund. Employer contribution to the recognized provident fund or superannuation fund. Approved superannuation fund. Now, this will be allowed as deduction under 3614. Now, in this respect, again, remember this. This is subject to section 43B. This is subject to section 43B. This is section 3614. This is also subject to section 43B, meaning that only when you deposit the sum, before the due date of filing the return of income, only then you will get the deduction of the employer contribution to PF. Otherwise, you will not get the deduction of the employer contribution to PF. Fine. Next one is the 3614A, which is the employer contribution towards the pension scheme. Employer contribution to the pension scheme under section 3614A. Which pension scheme we are talking about, which is referred in 80 CCD. Now, what is the deduction allowed over here? Here, the deduction will be 10% of the salary of the employee. Deduction, which will be 10% of salary of the employee. Salary here means salary plus the dearness allowance. Salary, basic salary plus the dearness allowance. So if the employer contributes to the recognized provident fund, then this will be considered as the deduction under section 36(1)(4)(a). Fine. Now again, remember over here, this is something which is in the nature of pension. The employer contribution to the PF is under 36(1)(4). Is under 36(1)(4), right? And this is in the nature of the pension scheme. This is in the nature of the pension scheme. This is not subject to the 43B. Only the pension scheme is subject to 43B. So, only the PF is subject. So, if you deposit the amount in PF, the employer deposits the amount in PF, it will be only allowed as deduction when it is paid before the due date of filing the return of income. Now, also one more thing important over here, which you need to take into consideration. This particular amount which is there, which is the employer contribution to RPF or SAF. This will be first considered as the income of employer under section 224. 224 is the definition of income. Under 224(10), this is considered as the income of the employer. This is considered as the income of the employer. So, this will be allowed as deduction only when you deposit before the due date of filing return of income. So, how will you show the presentation in the examination? You will first put income, you can write here employer contribution to PF considered as income under section 224(10) less deduction allowed under section 36(1)(4) read with section 43B. That is, if deposited to the RPF or SAF before the due date of 139(1). If it is not done, this will be only considered as income under 224(10). So, employer contribution to the RPF or SAF is considered as income of the employer under 224(10). It is allowed as deduction under 36(1)(4) read with section 43B. Employer contribution to pension scheme is under 36(1)(4)(a), which is 10% of my salary. Next one is the employee contribution to the RPF. Employee contribution to the RPF or SAF. So the employee's contribution, which is there, is also allowed as deduction. Employee's contribution is also allowed as the deduction. Right? Now, employee contribution, this is the employer contribution. This should not be there here. This is the employee contribution that I was talking about. This is the employee contribution which we have to write it over here and not employer. Sorry, my mistake. So, employee contribution to the PF. Employee contribution to the PF is allowed under section 36(1)(5)(a). Is allowed under section 36(1)(5)(a). Now, this will be allowed as deduction. Sorry, here you can change it. I have made a mistake over here. I'm so sorry. deduction is allowed under section 36(1)(5)(a). Deduction is allowed under section 36(1)(5)(a), provided what? That the amount has been deposited to the fund on or before the due date. Provided amount deposited to fund on or before the due date. On or before the due date. Now, what does the due date over here means? Due date means due date of the fund and not the due date of the return of income. So due date means due date of the fund and not the due date of the return of income. So here you will get deduction under section 36(1)(5)(a), provided amount deposited before the due date of fund. Provided the amount is deposited before the due date of fund. So section 43B is not applicable over here. For the employee contribution to the PF, the 43B is not applicable. For the employer contribution to PF, 43B is applicable. Are we clear about this? Okay. So, what is the first thing that we have done is the employer contribution to the PF, that is subject to the 43B. Employer contribution to pension scheme, it is 10% of salary. Employee contribution to PF, it is not subject to 43B. It is as per the due date of the fund. So this will be first considered as your income under 224(10), and then you will get the deduction under 36(1)(5)(a). Next one is the employer contribution to the gratuity fund. Employer contribution to the gratuity fund. This is section 36(1)(5). Section 36(1)(5), the employer contribution to the gratuity fund. Again, that is allowed as the deduction. Now, again, that is subject to section 43B. This is also subject to section 43B. Now, one more important aspect in respect of the employer's contribution to the gratuity fund. Now, this should be the approved gratuity fund. This should be my approved gratuity fund. Remember that thing. Now, approved gratuity fund, if it is to the non-approved gratuity fund, if it is in the nature of the non-recognized or unrecognized gratuity fund, then section 40A, section 40A(7) is applicable. Section 40A(7) is applicable, which is in case of the unapproved gratuity fund. So in case you are contributing, the employer is contributing to the provision for gratuity fund, is making the provision, then it will not be allowed. Or is contribution to an unrecognized provident fund or in respect of the unrecognized gratuity fund, then in that particular case, no deduction will be allowed. Are we getting that? So just write down. This is also subject to section 40A(7). You can write down provision for gratuity fund is not allowed. If you make actual deposit to the gratuity fund, only then it will be allowed to you. If you're contributing as a, or if you're just recognizing the provision, as I told you, provisions are not allowed. Provisions are not allowed, except it is for the ascertained liability and it is being capable of ascertain. It's a certain liability and capable of being ascertain, only then you will get allowance. Here 48(7) specifically disallows provision for gratuity fund. Subject to also section 40A(9), contribution to unrecognized provident fund is not allowed. Contribution to unrecognized provident fund is not allowed. Similar thing, you can write it even for the RPF or SAF. So contribution for the unrecognized provident fund is also not allowed. So this you can just remove it. It's not considered as income of the employer. This is also subject to 40A(9), contribution to unrecognized provident fund or SAF, not allowed. Fine. Now, any questions here? Employer contribution, as I said, Vanshika, it will be simple thing. You will just allow the deduction if you have paid the amount, if you have deposited the amount into the fund before the due date of return of income. 224(10) is for the employee contribution. 224(10) income is considered Vinay for the employee contribution. I had mistakenly written for the employer contribution, but that's not the case. It is for the employee contribution. Understand one thing very carefully. So 3614 is the employer contribution to the RPF or SAF. It is allowable provided you deposit the amount before the due date of filing of return of income. So that is subject to section 43B. The contribution to the Provident Fund, Gratuity Fund, SAF, that is subject to section 43B. 3614 is for the employer contribution to PF. 3615 is for the gratuity. Both are subject to section 43B. Secondly, provision for the gratuity is not allowed under 40A(7). Contribution to unrecognized provident fund or the gratuity fund is not allowed under 40A(9). Contribution to the pension fund is allowed under 3614A, which is restricted to the 10%. Which is restricted to the 10%. Are we clear? And then what is allowed additionally is the employee contribution to the provident fund. That is also allowed as deduction, but first that will be considered as the income of the employer because it's the employee's contribution. If the employer just, let's say, collect the amount and not deposit to the fund, it will be income. So that is income under 224(10). But that has to be deposited to the fund and only then you will get the deduction. And by when you have to deposit to the fund? By the due date of the fund. By the due date of the fund. There 43B is not applicable. Let's say, for example, I deposited after the due date of fund, but before filing the return of income, employee contribution, you will not get deduction. You will only get the deduction for employer contribution. Then the employee contribution will in fact be considered as the income of the employer. So it has been very well now clarified because earlier some courts had held that even 3615A is subject to 43B. But it has been clarified by the Finance Act amendment that 43B is not applicable on the employee's contribution. So the employee contribution has to be deposited by the due date of fund. Otherwise, it will not be allowed as deduction. And in case of EPF, what is the due date? 15 days from the close of every month. 15 days from the close of every month. So you can write down due date of fund here. 15 days from end of the month. Fine. Yes, any doubts, any questions? Okay. Next one is, next particular point over here. Let's understand. Now, in case of the employee contribution, remember one thing very, very clearly, that you don't have to make the mistake of allowing it before the due date or allowing it after the due date of the fund. You have to be very, very careful. In the exam, it may be given to you that the employee's contribution has, let's say, been paid on 20th of the next month. Let's say it has been paid, the 31st March, the March month's contribution has been paid in, let's say, instead of paying it by 15th April, it has been paid by 20th of April. So what you will do in that particular case? So even though it has been paid before the due date of the return of income, but it will still be not allowed as deduction. Why it will not be allowed as deduction? Because it has been paid after the due date of fund. Are we getting it? Now, one more important case law that I would want to discuss over here. So, let's say, for example, in case of the gratuity, in case of the, not the gratuity, basically in case where the payment is being made for the bonus. Now, that bonus is paid to a trust. And then the trust subsequently pays the bonus to the employees before the due date of return of income. Now, where the payment of bonus has been made, as I told you, the bonus is also subject to 43B, right? Bonus is also subject to 43B. Let's say I am contributing the bonus to the trust. I have formed a specific employees trust and I'm paying that amount to the trust, and then trust is disbursing that amount before the due date of return of income. Will the deduction be allowed under 36(1)(2)? Yes, will the deduction be allowed under 36(1)(2)? What do you think? Will you allow the deduction under 36(1)(2)? So, in that particular case, it has been held that the bonus which is paid to the trust by the employer, and then subsequently the trust pays before the due date of the return of income, this will be allowed as deduction to the employer. This will be allowed as deduction to the employer because here the bonus was ultimately paid to the employees before the due date of return of income. So even though the employer has contributed to a trust, 40A9 will not come into picture. This is not an unrecognized trust. This is the bonus. It's not contribution for the gratuity or PF. This is a bonus which is paid to a trust. 40A9 is applicable when? 40A9 is applicable when a sum is paid by the employer. When a sum is paid by the employer towards any contribution to any fund, trust, or association of person. Are we getting it? So basically that is for the provident fund or gratuity contribution which 40A9 is talking about. 40A9 will not be applicable when bonus is deposited to that fund or to that trust. And if the trust has paid before the due date of return of income, then 43B condition is also satisfied and therefore it will be allowed as deduction. So you can write down bonus paid by the employer to the trust. If the trust pays the amount to employees before the due date of return of income, under section 139(1), deduction allowed to the employer. Section 40A9 not applicable. Section 40A9 is not applicable over here. This is Supreme Court in Shashun. Supreme Court in Shashun Chemicals and Drugs case. I've written the spelling wrong. One second. Shashun Chemicals and Drugs Limited. Clear? Yes or no, students? Shafna, for the employer, the only condition is under 43B. For the employer contribution, there is only one condition under 43. So, I'm again reiterating, do not get confused. It's my mistake that I wrote wrongly initially, but do not get confused. The employer contribution will be allowed as deduction under 3613 and 3614 and 3615 for the gratuity. Both of them are subject to section 43B, which says if you deposit the amount before the due date of return of income, you will get the deduction. So if you deposit to the RPF, SAF gratuity, it has to be before the due date of return of income to claim the deduction under 3614 and 3615. So in exam, if it is given, you will quote both the section, the deduction is allowed or deduction is disallowed under section 3614 or 3615, read with section 43B. For the employee contribution, the deduction will be allowed to you. First, it will be considered as the income of the employer under 22410. Then the deduction will be allowed to you only if you deposit before the due date of the fund, not return of income, due date of the fund under 3615A. If the contribution is to the unrecognized fund, then it is disallowed under 40A9. Provision for the gratuity is disallowed under 40A7. Pension scheme, deduction allowed under 3614A, 10% of the salary. Yes or no? Yes, students, did you understand this thing very well? Fine. Now, if you look at the pension scheme which is there, as I said, the deduction under that is allowed to the extent of 10% of the salary. That is for the pension scheme, which is referred to in 80 CCD. Which is referred to under 80 CCD. So let's say, for example, if the employer contributes 20% of the salary, if the employer contributes 20% of salary as a pension scheme under 80 CCD, then how much will be the deduction here? The deduction will be restricted to only 10% of the salary. The excess will get disallowed. The excess will get disallowed. Fine? Yes or no? Any questions? Shafna, for the bonus to be paid by employer, again, it is subject to 43B. That is, you have to deposit before the due date of return of income. The bonus also paid to the employer. If it is contribution of bonus to a trust, that will also get allowed, provided you deposit before the due date or provided the trust deposits before the due date of the return of income. Clear? Last deduction for the employees, or employment related deduction is, it is for the section for the family planning expenses. Family planning expenses. Again, this is allowed under section 3619. So in case of the family planning expenses which are incurred, right? If the expenditure is incurred for promoting family planning amongst the employee, then deduction is allowed. deduction for promoting family planning. So, how much is the expenditure allowed? The deduction is allowed 1/5 for 5 years. 1/5 for a period of 5 years. Now, this deduction will be carried forward just like the unabsorbed depreciation. This deduction will be carried forward just like the unabsorbed depreciation. So carry forward of the deduction is allowed. As I said, it will be just like the unabsorbed depreciation. And in case of the amalgamation, the amalgamated entity will be allowed to carry forward. In case of amalgamated entity allowed to carry forward. Clear? So this is the employment related. First is the 3611B, which is for the health insurance for the employees in other than in cash. 3612, which is for bonus and commission paid to the employees for services rendered other than in the nature of profit and dividend. This is also subject to 43B and 48.2, which is related party deduction. If it is contribution to the trust, if the trust pays before the due date of return of income, still it will be allowed as deduction under 3612. Employer contribution to RPF or SAF under 3614. This is subject to 40A9, which is unrecognized, will not be allowed, and subject to 43B, meaning it has to be paid before the due date of return of income. You can write to be paid before due date of return of income under section 139(1). Right? Contribution to the pension scheme 3614A, 10% of salary. Salary is salary plus DA. Employer contribution to gratuity fund 3615. This is also subject to 40A7, 40A9 and 43B. 40A7 is if it is provision for gratuity, that is not allowed. Employee contribution to PF, first income under 22410. Then deduction if it is deposited before the due date of fund. For EPF, the due date is 15 days from the end of the month. And family planning, which is 1/5, is allowed over a period of 5 years under 3619. Yes or no? Is it clear? Next is finance related deduction under section 36. See, if you divide it like this, you will be able to remember the section. Otherwise, you will not be able to remember. So first is 3613. 3613, which is the just now we discussed 3613, which is what? Yes, tell me fast. 3613. What was it? 3613 students. What was it? Yes. Let me see who remembers. We just now discussed 3613. I just now discussed while we were discussing the depreciation. You have to remember these section numbers. Interest on borrowings. Yes, Mansha, very good. ICDS 9 is separate, but then you have to remember 3613 as a section. ICDS is a notified ICDS. By notification, they are coming in. But the section number under the income tax is 3613. Interest on the borrowing. This is allowed as deduction. This is allowed as deduction. So, if you remember, what did I tell you? The proviso 3613 says that the amount which is borrowed for acquiring the capital asset, the interest on that will not be allowed as deduction from the date when the asset is from the date when the borrowings are taken till the time the date asset is put to use. That will be capitalized. Fine. So you can write down. Proviso says interest on loan borrowed for the capital asset capitalize from or capitalize till you can write asset first put to use. Till the time asset is first put to use. That shall not be allowed as deduction. Next is discount on the zero coupon bond. Discount on the zero coupon bond. This is allowed on the pro rata basis over the life of the bond. This is under section 36(1)(3)(a). 36(1)(3)(a). Okay. See, which section numbers you have to short remember is bonus or commission 36(1)(2), employer contribution 36(1)(4), employer contribution to pension fund 36(1)(4)(a), contribution to the gratuity fund 36(1)(5), and employee contribution to the PF 36(1)(5)(a). These you have to remember. And interest on borrowing 36(1)(3). Rest of them, even if you don't remember, it's fine. Because these ones are very, very important. 36(1)(2), 4, 4A, 5, 5A, these are all going together. So not very difficult to remember. 36(1)(3), interest you should be remembering. Next one also you should be remembering, which is the bad debts. Bad debts. Now, bad debts are also allowed as deduction under section 36(1)(7). So, bad debts under section 36(1)(7). Now, this is very, very important. The bad debts are allowed as deduction under section 36(1)(7) in the year in which I am writing off. Right? Now, in case where the bad debts are claimed, there are certain considerations that you need to take into account. Now, what are the conditions? That the income should have been considered to claim the bad debt. And the debt should have been in respect of business or profession. So, the deduction of bad debts will be allowed only when the debt is in respect of business and it should have been considered as my income. It should have been considered as my income. So basically what it is trying to say is, you can write down, the condition is debt should be in respect of business or profession. It should have been considered as the income. It should have been considered as income. Okay, so these are the two considerations which you need to keep in mind. Now, it is also possible that the amount of debt is taken into account as income for the purpose of ICDS but not for the purpose of maintaining books of accounts. So it is possible ICDS may tell you to recognize an income even though you may have postponed the recognition in the books of accounts. And now if that debt becomes irrecoverable, you have not anyways considered income in the books of account. But because you have considered the income as per ICDS, it will be allowed to you as the bad debt. It will be allowed to you as the bad debt. So you can write down income considered as per ICDS if the debt becomes irrecoverable. Income considered as per ICDS but not considered in books of accounts and debt becomes irrecoverable, then in that particular case, it will be deemed that the debt has become irrecoverable and deduction will be allowed. Deduction of bad debt allowed. Now another important point over here. Now another important point here one need to note of. What if there is recovery of bad debt? What if there is recovery of bad debt? What if there is a recovery of bad debt? Now, in case the bad debts are recovered subsequently, if the bad debts are recovered subsequently, then in that particular case, you have two situations. The bad debts disallowed is less than the amount recovered, or the bad debts disallowed is more than the amount recovered. So you have two situations. Bad debt which was not allowed to you earlier is greater than the amount recovered. And second situation, the bad debt disallowed is less than the amount recovered. So it is possible that the amount is recovered in respect of any bad debt which has already been allowed. Right? Now, what will you do in that particular case? Let's say, for example, that for previous year, I was allowed the bad debts of only 40,000 out of the total bad debts claimed by me of 75,000. So let's say total bad debts claimed 75K, allowed by AO 40K. Now, let's say the recovery is 44,000. Let's say the recovery is 44,000. Now, how much was disallowed to me? 25,000. Let's say my recovery is 44K. This is more than 25K which was disallowed. Right? So now what I have recovered is 44K out of 75,000 which I had claimed earlier. Right? So ideally, my bad debts will be what? My actual bad debt after recovery will be equal to 75K minus 44K, right? Which is 31,000. Now, what was allowed to me actually was 40,000. Actual allowed was 40K by the AO. So the 9K which is there, 9K which is there, that is excess bad debt allowed. 9K, which is 40 minus 31. This will be considered as my income under section 41.2. This will be, sorry, under section 41.4, this will be deemed to be my income. This will be deemed to be my income. Now, what if my actual bad debts disallowed would have been less than the amount recovered? Let's say my amount recovered would have been only 22K and my bad debts disallowed were 25K. Now, what is the bad debt after my recovery? 75K minus 22K, right? So, how much it will be? 52K. Sorry, 53K, right? What is actually allowed to me? 40K. Then the difference which is there of 13K, difference which is there of 13K, this can be claimed as deduction. So if on the final settlement, the amount recovered where deduction was already allowed to me falls short of the difference between the debt which was actually due, which is 75K, and the debt which was actually allowed, which is 40K. So 25K is disallowed. Then the deficiency claim can be claimed as the deduction in the year of ultimate recovery. So this will be allowed as the deduction. Under section 36, under section 36.2, I can claim this as deduction. Yes. Any doubts, students? So are you clear about the bad debts? Yeah. This will be allowed to me as the deduction. Next is, understand the provision for bad debts is not allowed. The actual bad debts are allowed to me, except in case of 3617A, 3618. 25K is less than 44K. Okay, I've written it in a reverse manner. So 25K is less than, here it should be otherwise. Here the amount recovered is less. You are correct. The amount recovered is here lesser. The amount recovered is in fact greater than the bad debt disallowed. Here the amount recovered is, the bad debt disallowed is lesser than the amount recovered. So this should go that particular side. If the bad debt disallowed is less than the amount recovered, if the bad debt disallowed is less than the amount recovered, then in that particular case, you will get the deduction under section 36.2. So if you look at it, here I have written it in a reverse situation, so you can just change it over here. Here, my bad debt disallowed is lesser than the amount recovered. Here it is greater than the amount recovered. Here it should be greater. So if it is greater than, so 25,000 is actually disallowed to me. 25,000 is disallowed to me, right? It is greater than the amount recovered. Now after recovery, what is my bad debt? It is 53,000. What is allowed to me is 40K. So I still have 13K which is there, that will be allowed as deduction under 36(2). Are we getting that? Yes. Why is it confusing? So as I said that where the deduction has been allowed and if the subsequently amount is received and the amount is more than, if the amount is more than the deduction which has been disallowed. If the amount is more than the deduction which is disallowed, then in that case, it will be considered as my income. You can write it in reverse scenario also so that it becomes simpler for you. Let me put it this way. Bad debt allowed. Bad debt allowed is less than the amount recovered. Here, bad debt allowed is less than the amount recovered. Here also you can write that bad debt allowed sorry, here it should be bad debt allowed is greater than the amount recovered. Or disallowed only you should write, otherwise, it will become very, very confusing because it is in comparison to the bad debt disallowed. Bad debt disallowed is less than the amount recovered and this is bad debt disallowed is greater than the amount recovered. So if it is disallowed amount, what is the disallowed amount over here? 25K, right? This is less than 44,000, which is amount recovered. So what is the bad debt after recovery? 75,000 minus 44K, this is 31,000. What is actually allowed to me is 40K. So what I have done is actually allowed is 40K, which is more than the amount of bad debt that should actually be allowed. So the excess is allowed to me. Now I will claim this as an income. This will be taken as my income. If lesser is allowed to me, I will take that as a deduction. Yeah? Is it clear? So if I have received the amount after recovery, my bad debt should have been lesser, and if amount allowed to me is higher than that, then it will be considered as my income. But this is a case where the amount disallowed is lesser than the amount which is recovered. If the bad debt disallowed is greater than the amount recovered, then I will receive the additional deduction. If the amount disallowed to me is lesser than amount recovered, just logically you think. The disallowed is lesser than the amount recovered, meaning I have been allowed on a higher side and there is a higher recovery. So I should get that reverse what was allowed to me and this will be considered as my income. Yeah? Okay. Yes. Now, as I said, the provision for bad debt is not allowed except in case of 36(1)(7)(a). So bad debts on actual they are allowed. The provision for bad debts is not allowed except section 36(1)(7)(a), which allows the provision for bad debt. Provision for bad debt under section 36(1)(7)(a). Now this is allowed to certain banks. This is not allowed to every assessee. This is only being allowed to certain banks. This is for specified banks. Now, what is it? Let's write down. This is for specified banks. Now, to whom this is being allowed? To whom this is being allowed? This is, as I said, allowed to specified bank. So, a scheduled bank which is there, a scheduled bank or a non-scheduled bank or a cooperative bank other than the primary cooperative agricultural society, agriculture or credit society, or a rural development bank other than the rural development bank. For them, the deduction which is allowed under 3617A in respect of the provision for the doubtful debt, it is 8.5% of the total income. It is 8.5% of the total income. So you can write it over here, 8.5% of the total income. In case of such bank giving rural advances, in case these banks give the advances are made by the rural branches of bank. So advances, instead of rural advance, like advances given by rural branches of such bank, then the deduction will be 10% of advance. 10% of the advances. Are we clear? Any doubt? So basically, these scheduled bank, non-scheduled bank will get 8.5% of the total income to be allowed as provision for the bad and doubtful debt. Now, these bank at their option will also be allowed a deduction in respect of the provision made by it for any NPAs or doubtful assets in accordance with the guidelines which are issued by the RBI, which shall not exceed 5% of the assets, these NPA assets recognized in the books of account. Are we clear? So you can write down for NPAs, in case of non-performing asset, 5% of such assets. Okay. Next is for the foreign banks. For the foreign banks, the deduction will be 5% of total income. For the public financial institutions, PFIs, again this shall be 5% of the total income. 5% of the total income. In case of the NBFCs, the deduction will be 5% again of my total income. The deduction will be 5% of my total income. Just write down For NBFCs, again it is 5% of total. So only for the scheduled bank and the cooperative bank, this is 8.5%, and in case they make the rural advances, it shall be another 10%. In case of NPA, it will be 5%. Yes, only then here the deduction will get allowed of the provision for the doubtful debt. Other than that, the provision is not allowed. Other than that, the provision is not allowed. And in case the actual bad debts will happen, that will be adjusted against the provision. Only in excess of the provision, the deduction will be allowed under 36(1)(7). So you can write it over here. In case of actual bad debts, deduct, you can write bad debts to be adjusted against the provision for doubtful debts, and balance can be claimed as deduction under section 36(1)(7). Fine. Then there is one more deduction which is allowed for the transfer to the special reserve to specified entity. You can write down deduction for transfer to the special reserve under section 36(1)(8). So this particular deduction is allowed to the specified entity. Which are the specified entity? These are basically the specified entities are financial corporation, banks, cooperative bank, housing finance company, for them this particular deduction is allowed. So these should be engaged in the business of providing long-term finance for the industrial or agricultural development or development of infra facility. Engaged in business of providing long-term finance, one second. You can write like this: engaged in business of providing long-term finance for industrial or agricultural or infra development or housing finance. Okay. So in case they are the specified entity engaged in this eligible business, they are allowed a deduction of 20% of the PGBP. 20% of BGBP. Okay, because they have to necessarily transfer the amount to reserve. A special reserve is required by them to be created as per the law by which they are governed. So in that particular case, the deduction which will be allowed to them will be 20% of PGBP. And second is, it should be lower of three things. So lower of 20% of the PGBP, deduction which shall be lower of 20% of PGBP, amount transferred to the special reserve, or twice the paid up share capital. Twice the amount of paid up share capital and general reserve. Twice the amount of paid up share capital and general reserve. But this general reserve will not include amount transferred to the special reserve, lower of this. So the deduction will be allowed under 36(1)(8). Yes, this is a special deduction. You have to just remember this. In case the amount is withdrawn, then it will be deemed to be the income of the previous year in which the amount is withdrawn. Amount withdrawn from special reserve deemed to be the income of previous year in which amount is withdrawn. Yes. So for the finance related 36(1)(3), interest, then zero coupon bond pro rata, bad debts 36(1)(7). Allowed in the year in which you are writing it off, it should have been considered as income. If it is considered as income as per ICDS, then also you will get the deduction. In case there is recovery, then you need to see if the disallowed amount is lesser than the amount recovered. In that case, you will get the income chargeable under 41(2). If the disallowed amount is more than the amount recoverable, then you will get the additional deduction under 36(2). Provision for doubtful debts only for banks. For the banks, it is 8.5% of total income. In case of rural advances, it is 10% of the advance. In case of NPA, it is 5%. NBFC, foreign banks, and in case of the any other public financial institution, it is 5% of total income. A deduction of special reserve is allowed to the banks, which is 20% of the total income of the PGBP, 2 times the paid up share capital and general reserve, or amount transferred to special reserve. The lower of that will be allowed. Now, balance other deductions which are there under 1336. What are the other deductions that we have left out? So these are some smaller deductions which you should be just remembering for the purpose of for the examination. So just write down. Just write it down over here. Yes. So these are some smaller deductions that I'm taking it over. First is in the case of insurance premium paid for stocks. Insurance premium paid for stock. I'm not writing the section number so that you can just ignore these. You don't need to remember the section number over here. Insurance premium paid for the stocks. Next is premium paid by the Federal Milk Cooperative Society for cattle. Premium paid for the cattle. Insurance premium paid for stocks. What is that? So insurance premium which is paid for the stock, which is the normal stock in trade. So any case, insurance which is paid for insurance against the risk of damage of stock, that is allowed as deduction under 36(1)(1). Then premium paid for cattle by Federal Milk Cooperative Society. That is again allowed as the deduction. Next one is the deduction of the animals died. Deduction of the animals which have died. Deduction for animals died, which shall be restricted to the Or here, what will be the formula which you will have to use? So here in case, if you are claiming the deduction for the animals which have died, then this is actual cost of the animal minus the amount realized. Minus amount realized. Okay. Next is in terms of the expenditure which is incurred by the corporation, basically in relation to the objects of that particular corporation. So any expenditure incurred by a body corporate, if it is constituted by a central government, or if it is in accordance, the expenditure is in accordance with the object and purpose. So that is something which I'm just telling you, you may not choose to remember. Then is banking cash transaction tax, that is allowed as deduction. Banking cash transaction tax is allowed as the deduction. Then the amount of security transaction tax, STT, is allowed as deduction. So see, under the capital gain, STT is not allowed as deduction. But under the PGBP, you can claim the deduction of the STT. You can also claim the deduction of commodity transaction tax, CTT. Okay? Security transaction tax and commodity transaction tax. Fine. Yes, so 36 is over. Any doubt? Yes. Next is section 37, which is the general deduction. Section 37. General deduction. Now, there are conditions for claiming the general deduction. What are the conditions for claiming the general deduction? For claiming the general deduction, just write down the conditions over here. Section 37, general deduction. Yes. So, the deduction should not have been allowed under 30 to 36. Okay. Any expenditure which is not allowed or which is not in the nature of expenditure described in 30 to 36. So, expenditure not in nature of 30 to 36. Second, it should not be a capital expenditure. So it means it should be a revenue expenditure, not personal expenditure, which is laid out wholly and exclusively for the purpose of business or profession. That shall be allowed to you as deduction under section 37. So it should not be covered under 30 to 36. It should not be in the nature of personal and the capital expenditure. And it should be wholly and exclusively incurred for the business or profession. So if you remember, I told you, let's say for example, expenditure on share issue expense. That is allowed. That is not allowed because that is in the capital field. That's a capital expenditure. So it will not be allowed under 37 Brook Bond India case, right? Expenditure on bonus issue, that will be allowed under 37. Why? Because that was not in the nature of capital field. That was not for generating the new capital. That was just the transfer of funds from general reserve to the capital. It was just the reallocation of funds. So that is allowed under 37. Expenditure on convertible debentures, ITC case. That was again not in the nature of capital. Isn't it? So all these expenditure will be allowed to you under 37. These are revenue expenditure, isn't it? Now there are explanation to the section 37. First explanation says that any expenditure which is incurred, which is prohibited by the law, expenditure incurred, expenditure which is incurred, which is an offense for the purpose which is an offense, which is an offense, or which is prohibited by law, which is prohibited by law, this shall not be allowed as deduction. This is my explanation 1. The expenditure which is for any offense or which is prohibited by law will not be allowed as deduction. Now, what do I understand by expenditure which is for the purpose or which is an offense or which is prohibited by law? So, explanation 3 defines that. You have to remember this explanation. Explanation 3 defines that. So, the expenditure which is for any purpose, expenditure for the purpose, which is an offense or which is prohibited by any law, whether in India or outside India. Expenditure for purpose which is an offense or prohibited by any law in India or outside India. Second, which is to provide any benefit or perquisite, which is to provide any benefit or perquisite where the acceptance of such benefit is in violation of any law, rule or regulation. And acceptance of such benefit by the person is in violation of any law, regulation governing the conduct of such person. Now you will ask, ma'am, what is this? Let me give you the example of that. So what does 37 says? It is a residuary expense. So any business expenditure which is not allowable earlier, this will be allowed to you over here. Loss by fire, loss by theft, the expenditure on bonus issue, expenditure on convertible debentures. So this should not be only covered under 30 to 36. This should have been in respect of the business or profession wholly and exclusively for the purpose of business, should not be personal in nature, should not be capital in nature, should not be any offense or prohibited by law. So, what do I understand that prohibited by law or any offense? Let's say, for example, if I'm selling the drugs, whether it is allowed, answer is no. So that is not allowed to me. Are we clear?
I don't know that.
So that will not be allowed to me. Now, when it says about what is the expenditure which is in the nature of the offense, or what is the expenditure which is prohibited by law, that is given or defined in explanation 3. Now let's take an example. Let's say where I have incurred the expenditure in terms of the commission which is paid to the doctors by the diagnostic center. So the diagnostic centers are there, right? Now this diagnostic center may just give the commission to the doctor and tell them that, look, you refer the patients to us whenever any test needs to be done and we'll give you the commission. Now whether this is an offense or expenditure which is prohibited by law, explanation 3 gives you the answer. What is explanation 3 telling me? If any expense is for the purpose which is to provide any benefit or perquisite, and acceptance of such benefit is in violation of the law. So the Indian Medical Council regulations prohibit the doctors from receiving any gift, commission or bonus in consideration of recommending the patients. So this is generally not allowed by the Indian Medical Council regulation. Otherwise, what will happen? Doctors will engage in malpractice and that will have implication on the health of patient. So such commission paid to the doctors by the diagnostic center will not be allowed as deduction. Similarly, let's say payment which is made to the police to keep the gundas away. Now this is a bribe, isn't it? This is an offense. This is an illegal payment. This will not be allowed as deduction. Right? Second example. So what these pharma companies also do is, pharma companies basically grant the samples. They give the free samples to the doctors. Pharma companies give the free samples to the doctors so that they recommend their medicines to the patients. Now again, acceptance of such free samples from the pharma company is prohibited under the Indian Medical Council regulations. So if pharma companies claim the expenditure of giving this samples to the doctors, this will not be allowed as deduction under 37, because explanation 3 clearly prohibits that if any expenditure is incurred for the purpose of giving the benefit or perquisite, where the acceptance of such benefit is prohibited under any regulations, then in that particular case, this will be not allowed as deduction. So you can write down over here, giving freebies to doctors by pharma companies or commission by diagnostic centers to doctors is prohibited under Indian Medical Council regulations. Such expenditure disallowed under section 37. Such expenditure will not be allowed as deduction under section 37. Fine. Then last one, what is the expense which is prohibited by law? Any expense for compounding of offense. Any expenditure which is incurred for compounding the offense. Now, what do I mean by compounding of offense? Let's say, for example, if I am doing, let's say, some changes in my scheme of building. Now that is something which is, let's say, prohibited under RERA. Let's take an example. Now what I'll do is, I have done the violation. There is prohibition under the RERA. I have changed the structure of my building, which is not in accordance with the RERA law. Now I am paying the compounding fees to the, let's say, authorities. What is compounding fees? Penalty in lieu of prosecution. So that the prosecution should not happen to me, I am paying off the penalty. I am compounding the offense. Whether this will be allowed as deduction, the answer is no. Any amount paid to compound the offense is a penalty, and any penalty will not qualify for deduction under 37. Are we clear? Further, explanation 2 provides that CSR expenditure, which is incurred by the assessee, CSR expenditure which is incurred by the assessee will not be allowed under 37. So explanation 2 says CSR expense is not deemed to be in the nature of expenditure for the business. Expenditure for business or profession. Last one, section 37 2B says that any expenditure on advertisement in any souvenir, brochure, pamphlet published by political party not allowed as deduction. Expenditure for advertisement in any souvenir published by political party not allowed as deduction. This will not be allowed as the deduction. But where it is allowed, it is still allowed. Where is it allowed? So expenditure for the advertisement to the political party is allowed as deduction. Under which section it is allowed? Yes, it is allowed in as deduction. Under, yes students, 80 GGC. So you will disallow under PGBP but allowed as deduction under section 80 GGC. This is allowed as deduction under 80 GGC. But the contribution should be otherwise than by cash. Contribution other than in cash. Clear? Yes or no? Yes, students. Now, what about interest on income tax, interest on TDS, whether that is allowed? Answer is no. Legal fees, yes, it will be allowed. Interest on GST, yes, it will be allowed. Penalties under GST will not be allowed. Penalties under GST will not be allowed. Are we clear? So you can write down interest on TDS or income tax not allowed. Interest on GST allowed. Penalties under income tax or GST not allowed. Legal fees, yes, it is allowed. Let's say expenditure for directors' travel along with their wife This is also allowed because this is customary for the directors to travel with their spouses. So this is allowed as deduction because it is wholly and exclusively for the business. Yeah. Yes. And if you have any questions, we can discuss. Now, what we will do it in the next class is we will have 40 disallowances under section 40, 43B, that is remaining. And we will then start with the specified deductions. We will start with the specified deductions in the next class. Yes? Yes, students. Yes or no? Fine. So I'll start with the specified deductions in the next class. In case you have any questions, we can discuss. Otherwise, we can just close the session. We will revise. Yes? Thank you, Vanshika. So see, this is very extensive. You have to now start revising because now specified deductions are going to be more complex. And this is something which you will have to keep revising. Otherwise, it is going to be very difficult. Do you want to extend a little bit a session and shall we do disallowances under 40 also? Yes. Shall we do that? In case you're not tired, we can just close that as well. Yes, students. Those are again very small deductions, but will take another 20 minutes for sure. What do you want to do next class or this class? Let's find out. Okay. I understand you would be tired. And one more thing, we will have a specific session on the sums for the PGBP. After the end of the specified deduction on Friday, we are going to have a specific session only on solving the sums for PGBP. So do not miss that because now what you are doing is just theory. You have to practically start solving the questions. Okay. So thank you so much, students. See you in the next class. Okay. Let's close the session.